Good evening, good morning, everyone. Welcome to our webinar series. My name is Srinivas Kunte. I'm the Director for Professional Learning and Advocacy for CFA Institute. This is a practitioner series, and like every other episode, today's session is on something that is very relevant to the markets and the times that we are living in. The topic for today is leveraging quantitative indicators for macro investing. Wow, that's a mouthful. But if you just look at the learning outcomes, just three learning outcomes. The first one is, why is macro investing important? The second is an introduction to quant mutual funds macro investing methodology. And the third is a discussion of business cycles and precious metals. So most of you are practitioners, and you would have known that for the last month and a half, 2 months at least, it's all about the macro. A couple of days back in the Financial Times, there was a big report that how it was a lost decade for quant funds starting 2010. And now the same quant funds, they are coming back. And these are different types of quant funds. These are quant funds that are having their eye on the macro. They're using the macro to their advantage. Now, the speaker for today, they're not really they have explained to me that they are not really quantitative investors, and they will correct me if I'm wrong. What they do is they use quantitative indicators for macro investing. But let me not spill too much out of what I've learned after discussing with the speaker. Our speaker is really gifted, very well read. He is a fund manager at the Quant Mutual Fund, Ankit Pande. And his name is Ankit Pande. Ankit was a star stock speaker, and he has a very good understanding of how technology works because he used to work in a technology firm. I think he used to work at Infosys, and he's now a master fund manager. He's recently shared with me, I think a couple of months back when we were talking about his talk on how to use natural language processing. So I'm sure his next project is going to be on NLP. Ankit holds a Bachelor of Engineering degree from the University of Pune, and he has his MBA from the Chinese University of Hong Kong. Ankit is very scholarly. He was on the Dean's list for outstanding academic performance, and he was inducted into the Global Beta Gamma Sigma Honor Society as a lifetime member. He's very passionate about macro analysis. A few weeks back, he suggested to me, why don't I read I.G. Patel's monograph on his time at the RBI and so on. It's a beautiful book. Do take a look if you're interested in book reading. Especially Ankit is interested in the Austrian business cycle theory, and he loves challenging the status quo. Ankit is, of course, the CFA charter holder since 2015. I would welcome Ankit, but before we go into that, just to remind you all, we've got a 1 hour time limit, about 35 to 40 minutes of presentation, followed by Q&A. And during the presentation, as questions come up, do put your questions on the Q&A chat, because that will keep the discussion very lively, and we'll know what you really want. And after the presentation is over, my colleagues Harshada and Abhishek, they would be sending you a kind of a survey, asking from you what do you like, what you don't like, and what are the speakers you want. So do send your responses, because that helps us to get intelligence and keep this series running. Now, without further ado, I would pass on the proceedings to Ankit. Ankit, over to you.
Thanks so much. Thank you so much for having me on, Srinivas, and for the lovely, glowing introduction. And
hello,
it's been
Ankit.
Such an honor. Yeah, you can hear me.
Ankit, you there?
Yes.
Yeah, we can hear Ankit, Srinivas.
Yes.
Okay, fine. Yeah, over to you, Ankit. All yours.
Thank you.
Thank you.
No, thanks so much, and it's been such an honor to come on to this platform and speak to an august audience. We have quite a few of the attendees here. I imagine more than 100 or so, and it's been a wonderful time with the CFA Society in India as well as Hong Kong previously. So it's great for me to be able to talk to all of you and to give back some of the knowledge that I have and to interact with all of you. So really what today's session is all about from my perspective is really to talk about why macro investing is so important in today's times. Clearly a lot of volatility, a lot of macro news, a lot of geopolitics, all of that. And that really is in context of what Quant Mutual Fund, the company that I work with, really what we do in terms of deploying various macro tools, various indicators, various quantitative indicators, and then onto something that is rather near and dear to my heart, business cycles and precious metals. And it's not so much as to try and convince you to buy gold and hold it. It's nothing of that sort, but it's more just to tell you, or just to try and convey to you how important precious metals really are in analyzing business cycles and interest rates in monetary and fiscal policies. I hope I can just give you a gist of the theory around gold and the education around gold, which I do believe is severely underrepresented in today's times. In fact, quite a while, you would not really hear about teaching you about gold and interest rates. So really, it's about communicating that to you, and I hope you enjoy that discussion. Yeah. So really, as Srinivas mentioned earlier, I did have a stellar beginning with winning the Thomson Reuters Stock Picker Award in the IT sector back in 2014 with Quant Capital when we were on the sell side. And it was quite, looking back, I would say it was rather an easier time because it was a bull market, really speaking. And so, I mean, all the stocks were doing very well, but we still got a lot of calls right about difficult stocks as well. But what really, where the learning really kicked in was in the following couple of years, where we did see a lot of turbulence in the macroeconomic situation. Remember, the Euro crisis was going on. And so really going on to my experience with the technology sector, it was the big macro calls that we are making back in 2015, when the rupee was kind of stable from a period of pretty strong depreciation. And Dr. Raghuram Rajan came into the RBI, and he kind of ended stable. Now, we tried to read his situation as sort of maybe even hinting towards appreciation of the rupee, and that's where we took a big macro call and we downgraded the IT sector to a sell simply because of the appreciation of the rupee, which IT sector being an export-oriented sector, that would sort of make the sector unfavorable if the Indian rupee were to appreciate. And that didn't transpire, of course, but that was our first big learning, that even as we're trying to incorporate multiple macroeconomic indicators in our calls and the big picture calls, we shouldn't get things, get the big calls wrong. But that really is the beginning of a next set of learnings for me, away from just stocks and fundamentals, just the valuations as we would call it, into more bringing the outside parameters, the market parameters into play. And so we really learned a lot. And that is what I would try to convey to all of you, is to try and bring in the context, the macro, everything that you know about the stock and the market into play. And that's where I hope you will be able to learn some of the indicators and how we design them rather than what they are, how we design them, how you can build your own and invest successfully. Also, some of the Pareto observations on stocks and active fund managers. It's been shown in studies that over the last decade, just 20% of stocks account for all the returns of the index. As far as active fund managers are concerned, it's a double Pareto. It's 20% or 20%, just 5% of the months in the last decade account for all the outperformance of the active fund managers in India. It just shows the context that you've got to be aware of the style as well, and you've got to be consistent with the style of investment. Yeah. So I've really, whether you believe in the efficient market hypothesis or no, clearly there's some segments that are very efficient and incorporate news and developments very quickly. And also financial news is ever so interesting and ever so lively. And these days, you have the news channels announcing results so quickly, right? You barely can download the PDF and they're flashing numbers already and stock is moving. So the business model of decision-making is changing quite rapidly. And I would encourage all of you to try and be ahead of the curve, whether you are a portfolio manager, a small-time investor, or indeed managing larger funds in a more organized setting. So be like the Flintstones, they were ahead of the times. They had a drive-in theater. Mumbai only got a drive-in theater last year. Not complaining, but I hope all of you are well ahead of the curves, so to speak, as far as investments are concerned. It's your money, and wish you all the success in that way, and hope you can all build on some new dimensions to your investment techniques. Yeah. So moving on to the introductory part to our framework. As Srinivas alluded to it earlier, a Quant mutual fund is not focused on quantitative algorithms. We haven't touched the smart beta algorithms or any of that yet. That is clearly some work in progress, and we will get there over a period of time. But at the moment, we don't think it is the right time to focus on those. There is a segment of investors that like those, and we are not there yet. We are instead, we call ourselves very active managers. We are focused on very dynamic decision making, and we will stay active as far as in the near term is concerned, and for the schemes that you already are aware of in the public arena. And the session is really, as I said, to convince you to build your own quantitative indicators and your own approach and formulate your own processes. Yeah. And this is a more pictorial representation, valuation, liquidity, risk appetite, timing. That's our VLRT framework. We call it the VLRT framework. And well, I'd say outright that, something like valuations is really about fundamental analysis. And I will probably not touch on that at all in this session, because I think that's something that you guys are very well aware of. And a lot of you are far more expertised at that than I am, for instance, in many segments of the market, I'm sure. And timing is another aspect that I would say we have, you'd say is more of an art than a science at sometimes, but we do have an approach where let's say, valuations, liquidity, and risk appetite, all these segments of research give us a green flag, then we do believe that timing also should be right. But again, there is very difficult to say that it's a perfect 100% record. You can't be right all the time. But in this way, in working in this kind of a framework, you will tend to get decisions more right than wrong in the longer term. Yeah. And this is a nice representation of the rupee symbol as well. It had been up until recently the best performing currency in Asia. So well, maybe our framework also has that kind of strength. This is a more colorful triaxial representation of our framework, where we represent liquidity, risk appetite, and valuation on 3 axes. And you can see on the top left, despair and opportunity is obviously we're somewhere, let's say at the COVID lows in March 2020. That's where we were, where liquidity was sucked out, everyone was selling, and valuations and risk appetite extremely low, right? And slowly, the central bank started easing liquidity, and liquidity eased first, and then the valuations and risk appetite began increasing, and the recovery began. And probably today, we are somewhere close to the bottom right situation, as you might try and guess. There is a lot of pullback in the market, so valuations have receded a little bit, risk appetite has receded, and liquidity has consistently been receding, especially from the foreign institutional investors, between some days $500 million to $1 billion daily outflows. So somewhere close to the figure on your bottom right is where we probably are today with respect to the Indian market. That is just a reflection or a kind of representation of how we think things are today. So really, we are, we'll try and delve a little bit deeper now into the framework and certain elements and certain indicators, which will hopefully give you a flavor of how to build your own indicators. Even if you don't have some of the most advanced databases. Some advanced databases we do have access to, of course. So we really are students of behavioral finance, and we have over the last decade or so, sell side and now buy side, the two careers combined, Quant has had plenty of history and working experience with dozens of proprietary indicators constructed around perception, money flows, euphoria, capitulation, greed and fear, risk on, risk off, and so on and so forth. This is a more, you can say, arboreal representation, but really these are just the indicators, some of the indicators that we have today. And you can also think of it this way, that the typical 2x2 McKinsey matrix. You could have representations of summers and winters of equity investment. Summers of equity investments is when the environment for equity investment is very good, when inflation is low and growth, GDP growth is increasing. You would say that's summer, and spring precedes that. And on the other side, when interest rates are probably increasing because of fears of higher inflation, which is probably the case right now, GDP growth is declining. You would say that's winter. Probably we are in a winter today, although GDP growth rate, you could say, is increasing, but that's again, the basis is started because of the COVID years gone past, right? But probably we are somewhere in the winter of equity investment, if that's somewhere that could fit in that matrix of 2x2, right? So you could use these kinds of matrices to somehow simplify your analysis at some point in time. And we'll use that kind of matrix to understand a couple of the indicators around euphoria and capitulation. We'll come to them. A little bit on liquidity first, though. This is some of the databases that we use are a little bit advanced, like the EPFR, and our good friends at Elara Securities, Sunil Jain, who's the analyst there. He was an ex-Quant employee, a good colleague of ours. And this is his research from his report. Of course, you can see the US equities flows as a percentage of AUM between plus and minus 5%. There's a good a sort of a resistance and support line there forming. And since the beginning of this year, there has been a sharp reversal in the US equity flows. And that has sort of come off quite a bit. And you can see that's touching the all-time, pretty much the all-time highs around December 13. So that is a negative indicator as far as the big market is concerned, US equity market is concerned, that the equity flows are turning negative. And you can couple that knowledge with the figure below. That's the relative PE ratio of growth stocks versus value stocks in the US market. And we'll come to the Indian market because it's a very similar story. You can see in the 2008 financial crisis, ever since that time, growth stocks have had a great time of it over value. And now they've hit, in January 22, they've hit the highs of around 2.5x, hit the highs, taking you back to September 2000, hit those highs, and they're coming off as well. So this is something that we picked on, early trends that we picked on last year, around September 2021. In our communication to investors, we did say that we do see a massive change where growth stocks should probably be only a tactical part of the portfolio, and value should be the core of your portfolio. And that has started playing out in a big way. Of course, what really happened behind the scenes was the Federal Reserve's announcement in December 2021 was a big U-turn, a big hawkish U-turn. And that sort of has snowballed into a lot of the equity outflows, the de-rating of growth stocks, de-rating of the market, all that's playing out. And so on to the next slide, we see how the scenario is very similar in India as well. You can see that, again, this is a growth to value index, equal weighted index. And once again, the particular ratio has survived lows in May 14 and October 17, but has broken down last year in favor of value. And so even in India, you can see the same kind of story play out. And now, ladies and gentlemen, this is a little bit of background, of course, on liquidity. And again, I hope you can understand that although you don't have access to EPFR in the most common sense way, but If you just observe the flows and observe some of the commentaries, you can understand the change in dynamics of growth versus value stocks. And that is very key to pick up, even if you can't build indicators around this concept. But coming to capitulation and euphoria, this is where I can exhibit more clearly to you how things can pan out. And in this case, Quant has taken strong stance in certain cases. We were early on the metal bandwagon, so to speak. And middle of 2020, we went overweight metal versus you can see in the bottom chart there, the average mutual fund holding of metal stocks. And we were overweight ever since then, and we continue to be overweight. And you can see this is on top, you can see the metal stock, a representative metal stock in blue, along with this volume below, and the Nifty index in red. And what you can see is there was a classic case of capitulation in the metal stock pre-COVID. The stock continued to underperform all through pre-COVID era, and the volumes kept on declining, not with any great conviction. Therefore, the selling or the underperformance of the particular metal stock was without much conviction. Then, if that is the case of classic capitulation, then you have to wait for the perfect inflection point or a good inflection point. And that happened after COVID. After COVID, the stock rose in price, the outperformance was good, but with good conviction, with good amount of buying, volumes were nice. That you can see in the green boxes that I made on the x-axis. And that really proved to us that the capitulation seen in the stock pre-COVID was a sign that given that the inflection point is just around the corner, there could be good outperformance in the particular sector and in the particular stock. And that's what exactly turned out to be. So this is a way, again, you can build a 2x2, you can envisage a 2x2 matrix here, where you can put stock price outperformance on one side and volume indulgence on another axis, and you can have a matriculation where if the stock price outperformance is negative, but the volumes are heading lower as well, then that gives you a case of capitulation. And the opposite is euphoria, as we shall see. Excuse me. So in this case of euphoria, again, taking it as to how Quant did things around the IT sector, for example, in this case. So we were perennially or quite a bit underweight on the IT sector. Apart from a few choice picks, we really did not fancy the IT sector. And this is to exemplify that to you. This is another particular tech stock, just for example's sake. And you can see the tech stock is in blue and the Nifty index is in red on top. Right? And the story around this particular stock is that the fundamental performance is very good all this while. And then you can see that the performance is sometimes outperforming, sometimes keeping pace with the index. But the conviction is not there in terms of volume. The volume participation is poor. And then around September 2021, again, this is you have to study various angles of V, L, R, and T, right? So V, the valuations of fundamental part in Q2 of FY22, the September earnings, this particular stock underperformed peers, right? After that, it underperformed peers. So you can see the sharp underperformance after that. But not only that, the peers that outperformed, even they did not show any great outperformance with respect to the index or any greater conviction in the volume, in the volume participation. So there again, you have a classic case where through 2020 and 2021, the IT sector did outperform, but there was a euphoria. And then when the sign of euphoria was there in the first half of 2021, we started to take note of that and we started to go underweight. decidedly went underweight around the middle of 2021. And this is just to, again, show you that, demonstrate that to you. I hope, again, this is clear in terms of understanding the basic matriculation of stock price performance versus volumes. And therefore, it can give you very good signals. Again, you have to wait for the right inflection points, study the other elements of VL, RNT, and maybe you'll get there. Another part that we like discussing a lot is around volatility. This is the CBOE VIX index, of course, the famous VIX index. And again, I think the key point to highlight here again is that, the VIX tends to trend in the near term, mean revert in the medium term, but move in cycles over the longer term. You can clearly see cycles here. Between 1996 and 2003, there was one phase where the VIX was slightly elevated. And then after that, between 2004 and 2008, naturally, financial crisis, there was a sort of lull in VIX, and that played out. And then, of course, there was a big reversal. And then again, a lot of elevated walls until 2012. And then from 2012 to 2018, the VIX was very, very sullen. So very, very modest. That tells you we were all the time, we were cautioning investors around 2014, 2015 itself, that you've entered, yes, in a low era of volatility, but it could turn at any point in time. You're just waiting for an inflection point and other indicators, and things could turn very, very negatively for equity. Right, classic case, high VIX is bad for equity. So that started transpiring after COVID, and it's kind of played out. VIX moves in cycles over the longer term. This is the classic investor fear gauge, and we really love talking about volatility. I think even the Indian VIX has a shorter history, has therefore always taken a backseat compared to our in the United States VIX. But I think even that has had a long period of lull between 2012 and 2019, 2020. So again, you could be in for a sharp reversal, but again, the Indian VIX has sort of developed maybe over a period of time. Let's see. And now we'll move on to a kind of my favorite part, at least, the business cycles, with our focus really on understanding or getting introduced to the Austrian business cycle theory. This is slightly mesmerizing representation, I know, and there are all kinds of cycles, but it just pays, to just sit down once and over a weekend, maybe just go through some of the literature around some of these cycles. You'll find it fascinating. And this was Robert Dewey, who was the chief economic advisor to Herbert Hoover just before the Great Depression began in the United States. And he studied a lot of data and just came up that everything has been studied and everything has had cycles in the past. He studied all kinds of data, and this was his conclusion. And really something like the Hindu Yug, we're all familiar. I think the consensus is that we are in Kal Yug. That's not good. There's the demographic cycle. I think we're all aware again that India is relatively favorable position as far as demography is concerned, whereas Japan is definitely on the declining trend, and the United States, etc., are on that kind of declining trend as well. Something like the commodity super cycle has been brought to the fore in recent headlines. You would have seen, I think it was Goldman Sachs that said that the commodity super cycle is well underway, and we'll probably see 10 or 20 years full run of commodities. But yeah, our focus is on the innermost, in a way, the business cycle and business cycle theory as something that we understand from finance, has proper causal explanation, and something that you can build up your financial understanding around. Really, that's to say the least. And just before we move to the Austrian business cycle theory, so to speak, Austrian economics really is not just that it's being practiced in Austria, and all of that, we'll come to that later, but really it's a flavor, or it's a school of thought, a philosophy of economics that really represents classical economics, so to speak. And may I suggest that the CFA curriculum is absolutely brilliant at this. They have some of the best summary that I've come across, and they can I think if you would do far worse than to just go through the text in a very brief and succinct way. They have gone through decades of development behind economics and the economic thought, and gives you a very nice overview. So just to quickly run through this, the historical context is that until the 1930s, the classical view has been that the aggregate supply curve is very steep, prices and wages adjust quickly, and therefore recessions are mild and only short-lived. No need for government policy to intervene. Full level of employment would be restored. And a policy of active demand management can only harm, can only trigger business cycles, they say. This is the classical view. And the curriculum goes on to say that the depth and the severity of the Great Depression in the 30s, development of the so-called Keynesian theories, in which fiscal policies play an important role in stabilizing aggregate demand curve. The next point, rising inflation in the 1960s and subsequent stagflation periods triggered by the oil price shocks in the 70s were an incubator for another approach of monetarism, Chicago Monetary School of Thought. Milton Friedman, I'm sure, comes to mind for you. I'm sure. The school of thought highlights the importance of monetary policy and advocates stable money growth. The summary is really fascinating. So they say classical oriented economists have more faith in the working of the invisible hand, that is the proper functioning of markets, while Keynesian oriented economists see rigidities and market failures as more prevalent and government in a position to actively intervene. Right. So please consider, ladies and gentlemen, the Austrian business cycle theory, more affectionately known as ABCT. And I'm sure a lot of you would hear these names, would have known of Jim Rogers for sure, Peter Schiff, as a very vocal critic of the Fed for a long time. James Grant, Jim Grant, as we all know. He's most fascinating and most eloquent speaker. And not only that, he carries his bow tie really well. And that's something I tried to do a while back, but I just gave up. He's just a gem of an economist. And Mark Farber, of course, the Gloom, Boom, and Doom report. I'm sure you would have heard of them as well. But there are other contributions of Austrian economics as well, not just the Austrian business cycle theory. And they don't just talk about gold. There is something called this gross output, a measure introduced by Mark Skousen in the 1990s. And this is actually a figure that is now published by the Bureau of Economic Analysis in the US and is published on Bloomberg as well, those of you who have access to the Bloomberg machine, and even outside of that, of course, now. So that is something that is terrific. Gross output, really, to be very brief, it combines all the stages of production, doesn't leave the intermediate products out. So GDP measures just the end products and services. Gross output measures everything in the middle. And the obvious implication being that, you know, every stage matters in the economy. So this number works out to be over 50 trillion, well over 2 times the GDP figure of around 21 trillion now in the US. So that's an important, and that's more volatile. So he believes that there is more value to this figure. Hayekian triangle is another measure, or another more of a diagrammatic representation introduced by Nobel Prize winner Friedrich August von Hayek in the 1970s, if I'm not mistaken. And he brought this forth more as a sort of a representation of the lower order goods and the higher order goods. The higher order goods being, you know, those that are at the start of a production process, like metal and mining and agriculture, so on and so forth. Whereas the lower order goods are those of consumption. And so the literature is all about how interest rates distort the shape of the triangle, or distortion of the interest rate, setting the interest rate by the Federal Reserve, a manipulation of it downwards and upwards is playing havoc with the triangle, so to speak. Skyscraper index is a very, very interesting, as you can imagine, a real estate linked index which was introduced by another senior fellow at the Mises Institute, called Mark Thornton. And this is all about how, very interestingly, large skyscrapers begin their construction at the start of a boom. By the time they're finished, the bust sets in. And this has happened with many skyscrapers throughout the last 100+ years. In fact, even data is even before that. So very interesting if anyone wants to look into this. Other associated contributions you would be very thrilled to know, all of you who are fundamental stock analysts, that even your profession as such, fundamental stock analysis, is very core to how Austrians look at economics. They follow the money, pretty much follow the money all the time, right? That's what Jim Rogers also says. That's hardcore Austrian economics for you. Also, yield curve inversion is also a very interesting association with the Austrian economics as such. It's really not introduced by Austrian economists, but more introduced by the mainstream. But really, it serves to show how excess money supply in the long term versus a crunch of money in the near term, hence the yield curve inverting. And there's a recession, they call it a recession. That goes to show how money supply plays havoc with the economy. And that's at the core of what Austrians say. They don't like intervention in the economy. They think that the central banks print too much money and they benefit their own friends. And that's really leads to distortion in the economy and yield curve inversion. It's just another example of that, which I think everyone in the mainstream acknowledges that it exists. So it's another little quirky little association. And on to precious metals now. So gold really is the best money we have known for over 2,000 years. My professor in CUHK used to call it the anti-dollar. Professor Tom Bain, I remember him very fondly, of course, but this was his ultimate line: gold is the anti-dollar. The repercussion of this being that the central bankers don't really like gold. And of course, you can go back and look in the history of things, and the central bankers used to wake up in the morning. The first thing you used to check is the gold price. What's the gold price today? Because that's the system that they broke off from. That's the history that they left behind and instituted a fiat money-based system. And the connection to the business cycle, precious metals, is around the monetary involvement of gold, or not being involved in it anymore. When gold was the monetary system, because gold is finite, you can't expand the gold and money supply. So bankers can't print money, and because they can't print money, they can't cause interest rates to go lower than they would justify to go lower, and therefore there would be very little in terms of let's say a housing crisis, or let's say another systematic wrong banking kind of practices that allow bad loans to build up in the system. That just would not exist in that way. And if there is a bad bank that does bad loans on a golden system, the gold, there's an outflow of gold from that particular bank, they go bust, but not the whole system. So really fractional reserve banking today, as we know, where you keep just $10 down for actual 100 in the money supply, something of that sort, of course. I'm just speaking for work purpose, but that really is the central thesis of the boom-bust cycle of the Austrian business cycle theory, that fractional reserve banking and bad loans, and then bailing the banks out again and again, allowing them to further double down on those bad practices, all leads to worse and worse outcomes. And whereas the system that was there before of precious metals and of commodity-based money really was far more disciplined automatically by the market and did not need a Federal Reserve to govern it. And this is really the case for a 100% gold-based dollar, so to speak, gold-based currency. And of course, when we say gold, it could be gold, silver. There was even copper in circulation in India. Of course, there was a 1 rupee silver coin in circulation until 1939, after which they started diluting it. And that was an 11.6 grams, 95% silver that was in circulation. It retails for 1,400 rupees today. And that's a depreciation of 0.99%. So that just goes to show over a period of time how badly central banks and central banking has depreciated money. And this really throws it open to a little bit of a history that I would like to share with you on precious metals. Although there's a lot to go through here, but really I would like to pinpoint certain periods of time where it goes to show that if you study that and keep that in mind, studying financial history becomes easier. And the history with gold is intrinsically linked with big geopolitical events, sometimes even wars, and definitely recessions for sure. You can see, of course, 1913, the US Federal Reserve came into existence. 1933, US President FDR, of course, he confiscated gold from the US citizens and revalued it up. And then I think the US citizens weren't allowed to hold gold in person for about 40 years plus. I think 45 years, if I'm not mistaken. There's all kinds of shenanigans going on with gold back then, because it was the interwar period between World War I, World War II. A lot of things going on. You can look on the right-hand side, maybe you can see 1965, President of France, Charles de Gaulle, says it is impossible for the US dollar to be an impartial and an international trade medium. And of course, this is on the back of the 1945 Bretton Woods Conference, where the US dollar was made the world reserve currency, but it was backed by gold. It's supposed to be backed by gold. John Maynard Keynes, even at that time, was absolutely fighting for a fiat-based currency system, one world currency, not just fiat-based, one world currency, even back then, 1945. And in 1971, of course, the US dollar just could not keep up with the pressure on the gold outflow. And President Richard Nixon announced a temporary breakage of the US dollars linked to gold, which turned out to be rather permanent. So that was a big Nixon shock. And then after that, ladies and gentlemen, there was so much more to talk about, but 1973, you can see Paul Volcker's statement here: joint intervention in gold sales to prevent steep rise in the price of gold. On to the next page. There's so many comments here, and you can look at the first one, Fed Chair Arthur Burns. You can look further down, second row, 1988, Chairman Greenspan. All these comments and actions. 1999, IMF initiated a further 5-year central bank gold agreement. These are all deep interventions by central banks, big Western central banks. The BIS also got involved. Big interventions in the gold market by them to calm down the price of gold over and over again, because central banking, remember, gold is the antidote. Central banking and gold are antithetical. They don't go with each other. So these guys are trying to get a hold, get in the reins of gold, and was running away from them time and time again, right? And then it's evidence of huge price movement in the early 2000s, ending in 2008. Another big shock to the gold price is probably underway today as well. And you can see the central banking action is all about trying to quell speculation on gold, or trying to control its price. And that really, all this data points is really tell you that monetary and fiscal policy, if you really want to study it at length, it's really incomplete without studying gold and what the action on gold will be. So if you want to find out the future direction of, of the stock market, of the investments that you have today, or of monetary policy, inflation and interest rates are very important to the direction of the equity market. You have to study gold market a little bit. You have to be able to understand that there is furious action going on in gold. And one hopes one day gold will come back to be the king. We're all Austrians now. All we do is Austrian economics. There's no other economics we know of. That's the world I dream of. Let's just hope that things improve from here, that inflation quells, and that our investments are back on a good path. But you have to look around this whole conundrum of money printing and of discipline or lack of discipline by central bankers today, and that it has to be reined in. And with that, amen, and back to you. Thanks so much.
Thank you. Thank you very much for the very insightful presentation. I've got there's lots of questions really, so I don't know if we'll be able to cover all of them. But let me start quickly. If you can, Amit Soni had a lot of questions on the methodology and philosophy for Quant Mutual Fund, and one of the presentation slides also. So if you can take up slide 7, Ankit, and just walk us through any one of the indicators. I think you did a very nice give a nice explanation on the volume for the IT company, and how you switched that the volume was dying, that's why you switched it. So can you give one or two couple of examples on for slide 7, where you've got this nice graph, right?
Right. If I just share that screen, is it? This one.
Yes.
Yeah. No, I mean, as I said, I think pretty much, let's say COVID was pretty much top left, despair and opportunity.
So where does gold fit in? Like, gold was the last slide. So let's take gold, and let's take any one graph. And if you can just quickly, like in a minute, if you can share your wisdom.
On gold, in this particular framework, as far as valuation, risk appetite, and liquidity is concerned, VLRT is really a framework that we've developed in equities, so to speak. Where gold comes in is in some of our schemes. Of course, we have a multi-asset scheme where we do keep a proportion of gold and exposure to gold ETFs as we are allowed by the regulations. That proportion has varied over time and very much in sync with what we believe the gold price performance will be over the next 3 months. So currently that's closer to 20%. In the past, it has been as high as 60%. And that's really as much a reflection of gold price not being able to perform well, you would say. That's the proportion is rather low, but also we do see some kind of pullback in the market and for equities, generally speaking, and therefore we believe the remaining 80% of the particular scheme will be all right. Will deliver some kind of market performing returns or outperforming returns over the next 3 to 6 months, is what we can say. So really, it's about the VLRT framework. Really is about more equity investment selection, so to speak. Yeah.
Okay. So for example, now you've got this red color, dark red color, triangular, right? Why is not an ellipse? Why is it not a circle? I don't know. I mean, so let's.
That's just a connection of the points that we see. Valuation is it's probably high, very high, close to the top end. Risk appetite, if you're talking about the redmost bottom right figure, risk appetite is probably right to the extreme as well. And liquidity is being sucked out of the market. the tremendous amount of FIIs selling, liquidity is being sucked out of the market. Now, it's not absolutely close to minima as the figure shows. So it's somewhere a little bit ahead of that liquidity is set. So that probably is not absolutely the perfect representation of what the situation is today.
Right. So that leads me to another question from Prajal. So she is saying that how can liquidity in the economy be tracked for a small scale investor like me? Are there any leading indicators?
M3.
So you said FII.
India M3. India M3 is a very, very strong indicator. India M3 is a very strong indicator. If you want to be more global about it, use the United States M2. If you want to get a little bit technical about it, and you can use the United States, again, an Austrian bend, United States TMS, true money supply, TMS, true money supply. You'll have to work a little bit hard on it, but there are sheets available. You can download them on the websites of, I think it is the BEA. You can work that through. That is a more accurate representation of United States money supply. That's all that they argue upon. So if you believe that you have a better proxy, go ahead with it. But basically, it's something of that sort, yeah.
Right. So the India indicator, which website would that be on?
No, the RBI websites, the India M3 money supply. That's it. Yeah.
Okay, fine. So Cord has just asked a question. So that means, given this diagram, the valuation, liquidity, and risk appetite, they are all equal weighted in your framework, or they are?
Yes, one third, pretty much. What we say, I mean, since it's VLRT, right? We say that when we L and R we're pretty convinced that a particular investment is good from all angles, V, L, and R, then the timing is good. Then we go ahead and we should invest. Conversely, when V, L, and R are sort of all not quite right, going badly, then we should sell. That is probably right. And therefore, what I'm trying to imply is that the in-betweens are not very obvious. There are situations where we have invested when the valuation part, the fundamental part is not quite hunky-dory, but the liquidity and the risk appetite is great. So we have a little bit of a flow with respect to how we go about VLRT in some cases, which is first we do risk appetite. We do check the market's risk appetite. If the risk, I think the proverbial, if you watch a little bit of financial news, risk on and risk off is often talked about, right? So if the risk is off, which pretty much is the consensus around today's time, then we do look for something that will give us comfort on valuations part. Valuation should be low, and that gives us comfort to enter, provided other things check out, of course. And conversely, when the risk is rather sort of on, when the risk environment is on, then we do check for good liquidity in the particular stocks. Now, for a small investor and for an individual investor, probably liquidity doesn't matter as much. But again, if you're investing in ultra nano caps, you have to be careful. If you invest sizable sums, you have to be a little bit careful. So that's probably how we go about things.
Right. So Sahil has a question on liquidity as well, but let me come to that later. Word is saying, is there a cycle with VLRT? I think on slide 15, is it? You've got lots of cycles. So have you discovered a cycle with VLRT as well?
Pretty much so. It's pretty much going from top to bottom, from left to right, and then back again, right? That's how it should go. I mean, probably if at one point in time, if the recovery is only partial and then there's a macro event or some externality, then do we go back to despair and opportunity all of a sudden and begin again? Could be, but by and large, this is pretty much a cyclical representation. You're right on that. Yeah, true.
Yeah. So if you're a long-term investor, right, Ankit, you wouldn't be bothered about these things, right? You like a particular company, you like their business model, you think there's a moat. I mean, good old school of the Doddsville school that they call, right? So if you're a long-term investor, how do you juxtapose your methodology with long-term investing?
Very great question. I think we are somewhat unique in the mutual fund industry in that we do say that, timing is important. We sometimes even said timing is everything. It's important. Try not to enter at the top of the market, if that makes sense, even for the long-term investor, right? Entering at the top end of the market is pernicious and can shake your confidence immediately if you enter in a big way at the top of the market. But yeah, by and large, what you say is absolutely agreeable. And if you recognize these phases of the market that you're in, and if you understand them, if you can compare the PE ratios of our market today with other markets, understand that we probably still are a little bit overvalued, you will probably be able to place your bets better and phase them out, phase your investments out. Your entry points are going to be better. So there's always room for improvement in the way you do things. And I think this will only help. This can only add on. Also, sometimes I feel that, long-term investments, we do love the idea of, understanding stocks, understanding industries so well. And we just sometimes become complacent about it. We don't appreciate the timing aspect. I sit here and very praised to say that we don't time things well all the time. Very, very difficult. Timing is that element, VLRT, that T-bit is still a little bit of art than science, So it's not to be gone unnoticed, and I hope one learns over a period of time how to time things better. That's what I can say. Yeah.
Right. I mean, they do say CFA Institute in the curriculum, right? If you recollect, and if everyone recollects, timing is nothing, right? It's and stock selection is nothing. It's ultimately the asset allocation. But let's move on quickly. Shantu has got a question. Do you use alternate data sets like news sentiment, etc.? There's a related question from Shrish Vaze as well. They wanted to understand AI and machine learning. My understanding, you don't use any of this right now. Is that right?
Yeah. Well, AI and machine learning is something of a work in progress. We will have something maybe in a couple of years' time. We do believe that we can enter into that kind of domain where we do have that kind of computing power. We have a large in-house sort of a software team and development team that is working on that kind of an initiative. So that is something that is in the works that will come through, I hope, in a couple of years' time. But with regards to alternate data sets, again, you use it as one of the pointers. So there is something called as the Economic Policy Uncertainty Index. And they have, I think it's pretty much economicpolicyuncertainty.com or maybe .org. I'm not connecting at this point in time, but you can have a look at it. They have a fantastic collection of indices country-wide across the world as well. And you can go and have a look at it. The constitution of the index is pretty much around newspapers and around NLP of the words that are used in the newspapers, shock, horror, crash, and all that kind of thing. All that goes into it. So it's a fantastic indicator. You should have a look at it, I think.
Right. So we are coming towards time, but there's three important questions that will probably help the audience here. Something about yourself, or the soft skills aspect of investing, right? So how would you describe your personality? How would you describe your disappointments, and how would you handle them? That is part one of the question. Part two of the question is, can you tell us a little bit about your team? And part three of the question is, career paths and skills that you would recommend. Sorry for jumping all these questions in one go.
No, I think I have been very fortunate. I have a family, a very supportive family of bankers, and they kind of always had me going in this line. I love my IT earlier in 2007, 2009. I love that. And I still continue to do something on the side, even as I prepared for my CFA 1, 2, 3. I always kept in touch with the software, and that continues to be a passion, R and Python and all those things. I think my one message to anyone with almost any profession, and especially in finance, I think you have to be multifaceted. You have to pick up skills on the software side now, It's becoming imperative. And as I said earlier in one of my slides, I think it was the second slide, the business model of decision making is changing. But one thing that does not change is the experience you garner as well. So it's a software and skills, again, 2x2 matrix. Software and skills and the IT and the financial skills on one side, but the experience on the other. I think both will build with you over a period of time. Be patient, be gentle, be humble. All things will come to you. Be a nice person, be a gracious person. Thank God, and believe in yourself. And I think good things will come to you as a person. I think one of your questions was.
Do you have any openings in your team? And can be
we do have a large team now. Sort of space is only as big. Our team strength is about, I would say, 10 odd in investments. We have a bunch of young analysts who are working very hard in different areas, and we work in a very different way. So if you ever come to our office, we've got all kinds of little graffiti on the walls. We've got things such as geopolitical analyst, cycles analyst, all that kind of projects going on behind the scenes. So if you ever, if you come in contact with a promising professional who is willing to learn about these new aspects of finance, we are open. We have vacancies, yes. And that's one part of our team is the investments, around 10 people, but we have another 10 people in development and support of the IT systems. And the fund managers is probably a third part of teams, not so big, but yeah. We feed off the energy of the other two teams so much. So we built a system where, we have multiple points of dependencies, not singular. So our risk management, so to speak, or our points of failures really are distributed and diversified. So we tend to make fewer mistakes, I hope. And we have multiple managers in that sense. Our schemes are managed by multiple managers. And we also make the decisions we can make. As I said, VLRT is sort of a distributed way of making decisions, so we make less and less mistakes, even if we have some errors in collecting our data points, but we tend not to make a lot of mistakes, let's just say. And hopefully the outperformance that we've shown in the markets, hopefully that will continue.
Right. So can you give, the job aspirants, and they may not necessarily come to you, Ankit, 2 homeworks for them to do so that they can shore up their CVs and bio? You already mentioned they should learn something about software.
Why don't they read something about Austrian economics? I've been going on all about it. So maybe read up some books. Actually, very funnily, you might find this funny. I don't know. They're one of the main websites for Austrian economics now. It's Mises.org, set up by Professor Lulan.
What is it? Sorry.
Mises.org.
I got it. Yes.
It's one of the most influential educational think tanks in the world today. And they put out the books of all these famous people, the fantastic books and treatises. They put up the PDFs for free. They believe that the PDFs, the electronic versions, are one form of economic good, and the physical book that you have is another form. It's a different form of good. So I've got like 50 or 60 books from the Mises Institute in my house. And I've read all of those in the electronic copy, I think. But I love them so much to be having them in my drawing room. That's a fantastic pleasure. So I would encourage all of you to pick up something or the other from the Mises Institute. Go read it. A lot of it is very simple language. I think the best starting point would be Economics in One Lesson by Henry Hazlitt. I think it's a fantastic read. It's a good economic lesson. It's not, I'm not showing you something like, one of those software for dummies, that kind of, it's not that. It's a very, very good, a lot of economists today in the market don't like to think this way. Like the way the book tells you, it's a very simple and honest classical economics kind of way of going about it. So I think it's going to be worth your time.
All right, fantastic. Great talking with you, Ankit. We have over time now. Thank you very much for our viewers and listeners to for coming in into this session. Our next session, be tuned. Harsha that has put in some links there, is on Thursday, 9 June, by Niti Agarwal. I'm sure you're going to like it. See you soon, and thank you very much for joining.